Hey guys, welcome to Pips Trader YouTube channel. In today's video, we're going to be seeing about the basics of Japanese candlesticks, some samples in the actual charts, real charts. There are different types of charts. Here we have the candlestick chart, and here we have the line chart, and Henkan Hashi, Renko, bar chart, and Kagi chart. Mostly people use the candlestick chart. Let's see the actual chart in a trading platform. So this is tradingviews.com, and here you have the option to choose charts. Okay, here we have bar chart. So once you click it, you have the bar chart appearing here. You can see the opening price and the closing price are shown here. Go to the next candlestick chart. Next we have Inkanashi. So in Inkanashi you can see there are no down shadows here, only upper shadows. And we have the line chart. Line chart are drawn on the closing price of the price movement. So whenever the price closes, a dot is drawn there, and every dots are connected, then the line chart is actually created. Now I am seeing at the day time frame. You have weekly time frame, 4 hours time frame, and 1 minute time frame also. So a Japanese candlesticks has basically two components: body part and a shadow portion, and again also downside shadow, down shadow, upper shadow, and we have the actual body. The green candle represents the bullish candle, and the red candle represents the bearish candle. So in a bullish candle, the opening price is on the bottom, and the closing price is actually on the top, which means the market opened at the bottom and it went up. Okay, the price from bottom, it raised up and it closed on the higher points. The shadows resembles the highest point at a given time frame. So in the previous slide we saw about different time frames, no? 1 minute time frame, 5 minutes, 2 minutes, 3 minutes, many time frames are there. During that time frame, when the candlestick formed, it actually went the highest price up to here. Then it didn't hold. There were no buyers or sellers at this price. Then it withdrew back and closed at this location. Okay, that's why the body is actually formed. Then whereas the bearish candle, the shadow, the price actually opened here. Okay, and it tried to go up, it couldn't hold it there. No, there was no buyers or sellers. Then the price went down and actually closed here. So price closed on the negative. So it represents the price fall and downtrend. So the opening price is over here and the closing price in the bottom of the candle. And you can see the wicks again. Wicks are up to here, the price went, but it couldn't hold. There were no interested buyers or seller at this location. So the price retrieved back or retraced, we can say. Okay, so the actual transaction that happened is actually at this location where the actual body is formed. Okay, even at the bullish candle or the bearish candle, wherever the body is formed, that represents the actual transaction happened. And we have the bullish candle and the bearish candle. Okay, so the bullish candle represents the market being bullish. So price starting from bottom and directly going up. It's a bullish market, uptrend. Okay, the bearish candle represents the price opens higher and the price being dropped down. From the opening price, the price has reduced to a lesser price. Let's see some example from the actual chart. Here you can see the price actually opened at the low, and you can see the price actually going up. It's a bullish market. And also the longer the candle shows the strength of the candle also. So a lot of buyers were interested to buy at every stages of this price. Okay, this whole candle represents the bullishness of the candle. Next we have the red candle. Okay, red candle, the price opened on the top and then it went all the way down. So the price again retraced, and still it shows the bearish candle. It closed in the bearish market. Okay, again the following candle also was a red candle. It shows that the bearish trend was still there. Let's see some examples of commonly occurring candles now. Here we have marubozu. It's a Japanese word actually. So here we have the bullish candle, the price opening at the bottom and the price closing on the top. Marubozu candle represents the interest of the buyers. So they were interested in buying at every stages of the price. So the candle suddenly opened and there was rush in buying. So there was no time for lower shadow to form. It went traced all the way. Boom, it went up and it closed also without any shadow, which means there were more buyers to buy at these prices also. But this candle time frame closed. So this candle formed without any shadows on the top or on the bottom. Next we have the bearish candle. Bearish candle represents the negativeness of the market or the price falling. When the price opened, the opening price is on the top and the closing price is on the bottom. And you can see the body of the candle. The body of the candle doesn't have any wicks at all, which means that there were a lot of selling pressure in the market. Once this candle opened, the price started falling without any shadow all the way down and closed without any wicks, which means there was a lot of selling pressure in the market. Let's see some example in the actual real market. Here we have the bearish candle. So bearish candle, you can see Marubozu, there is no upper shadow, there is no lower shadows also. The full pressure on sell was very high, volatility was very high. So once the candle opened, it brought the price all the way down. Here we have the tweezers. We have bearish tweezers and bullish tweezers. Okay, bearish tweezer and bullish tweezer. It can be formed on the top or at the bottom of the trend. Usually represents the trend reversal. You don't have to worry about the color of the tweezer. It can be the red candle or the green candle. So which means the price tries to go up and then retrace back. It couldn't sustain there. Again, it formed another candle, tweezer candle. Again, it tried the same level. Again, it couldn't hold it there. This tweezer represents the bearish trend reversal. The next one we have the bullish tweezer, which is actually forming on the bottom of the downtrend. So tweezers are usually represented by two candles. So you can see the first candle going down and then trying to sustain here. It couldn't sustain. Again retraced and the price closed at this level. Again another candle formed. Again it tried to go down at the same level. It got rejected. It couldn't sustain at this level. Then again the candle retraced back. So the trend reversal is happening to the bullish. The market is turning into bullish market. Next, we are going to see about the doji candles. We have 5 kinds of doji candles. They're all representing the indecision in the market. We have gravestone doji, where the price started at the bottom, opened at the bottom, and then it tried going up. Boom! Again, the price couldn't sustain at this level. The price fell again. And the opening price and the closing price are all same. This is gravestone doji. Again, we have long leg doji. Long leg doji, where the price opened in the middle, it tried going up. Again, it couldn't sustain here. Again, the price tried to go down. The buyers tried to take it up. It couldn't sustain here. Then the sellers started to take over the market and try to push the market down. Again, it couldn't sustain here. Then the opening price and the closing price happened in the middle. So this long leg doji actually has a longer legs, longer shadows. Next we have dragonfly doji. Dragonfly doji, and here the market opened on the higher level. It tried pulling up. It couldn't sustain on the top higher level. Again the bearish started entering in and tried to bring the market down. And then again the bearish couldn't also close it here. It shows both the bearish or the bullish couldn't sustain the market, and it closed at the same level as the opening price. Okay, here it is actually neutral doji. The price tried to go up, it couldn't sustain, and the price tried to go down, it couldn't sustain. Only the shadows were formed. So bearish were also weak, bullish were also weak, and the price closed at the close of the same opening price. Here it is actually 4 price doji. 4 price in the sense when the market opened, there were no interest or less volatility in the market. The buyers were not also interested, sellers were also not interested. So the price didn't move at all. It opened and closed at the same level. There were no shadows formed also. Let's see some examples from the actual chart. So here you can see 4 doji, 4 price doji, where only one line is here. So usually this kind of candles forms in a low volatility market actually. So when you're trying to trade a stock, first you have to see the volatility of the market. When there is no enough buyers or sellers, and it's better to avoid trading at that stock or at that time of the trading hours. Here also you can see doji formation, doji formation. So we can see lots of doji formation. So next one is actually hammers and inverse hammers. So hammers and inverse hammers represents trend reversal. They usually form at the bottom of the downtrend. They represent trend reversal. There is a bearish market, price falling down. Then we have the hammers forming. Then the trend reversal is happening. We have inverse hammers also, which means we have the shadows on the upper side and the trend reversal is happening. The one thing we have to note about hammers is actually just seeing the hammers doesn't give the confirmation. So once the hammers are formed, you have to wait and see for the confirmation on the next candle. So next candle has to close higher than the hammer. Next candle, let's say the higher. So next candle has to close higher than the hammer. Then it gives a confirmation that the trend reversal is actually happening. Otherwise, just candle formation doesn't show that trend reversal is happening. Next, we have the hanging man. Hanging man usually forms at the top of the upper trend. It usually represents the trend reversal. Uptrend. Then the candlestick, hanging man candlestick forms. Then we have the trend reversal happening. At this one also, we have to wait for the next candle formation and confirmation on the next candle formation. Without the confirmation, we should not assume that it's a trend reversal. Let's see some example from the actual real chart. Here we have inverse hammer. So it was a bearish market, price falling. Then we have a bearish completion. There is also doji, which is saying that indecision in the market. Then we have the inverse hammer forming. Then the confirmation actually happens when the next candle is forming. This is actually bullish candle, which is closing higher than the actual hammer, inverse candle hammer. So it is representing the trend reversal. Okay, let us summarize what you have learned so far. So we have learned the basics of the candles. The candlestick consists of 2 parts, which is the body and the shadows. The highest shadow represents the highest level the price has traveled, and the lowest shadow represents the lowest level the price has traveled. We have a candlestick here and we have the shadows here. This is the highest level where the price has traveled and the lowest level where the price has traveled. And this is a body. Body represents the actual trade where buyers and selling transaction happen. The actual body forms only when actual trade happens. We have learned about Marubozu candle. Marubozu candles don't have shadows and it represents the volatility in the market. So it doesn't have any shadows here or the lower shadows. It represents the volatility in the market where the intensity or interest of buyers and sellers were high. So the candle didn't have time to form shadows. It can be the bullish candles or the bearish candles also. Next we have tweezers. Tweezers are usually formed in pairs. They can be found in the uptrend or downtrend also. And the length of the shadows of both the candles are same length. Next we have hammers and inverse hammers. Hammers are usually formed at the end of the downtrend and it indicates trend reversal from bearish to bullish. Next we have doji. In doji we have 5 kinds of doji, but usually when doji forms, it represents less volatility in the market. It shows the indecision in the market. Nobody is interested in that particular price level. Next, I want to highlight very important point, which is actually even though we are very good at finding out different kinds of candlesticks, they should not be traded alone. You have to trade candlestick patterns along with some indicators. Okay friends, thanks for watching this video. We have come to the end of this presentation. If you like this video, please like it and comment it if you have any questions and share it with your friends.